2022 has been full of surprises so far. Unfortunately, most surprises are rather negative. And if you have been watching the news, you have seen that stocks have been really going down this year. And to make matters even worse, the Federal Reserve and other central banks around the world have started to increase their interest rates. Some people panic and think that the interest rate hike is going to make the stock market crash. Other people think that it's no big deal, that the stock market is going to rebound and keep going up just like in 2021. It is understandable that many people are confused, facing such different versions, but what can we really expect in 2022 with rising interest rates? That's exactly what we're going to find out in this video. We're going to see why the stock market went up so sharply and also what will be the effect of rising interest rates. Let's dive in. But before we get started, please hit the subscribe button down there and activate the notification bell to never miss a new video. We can say that 2021 was a crazy year for the stock market, and we can say the same for the entire 2010 decade. Stocks have been doing only one thing, going up, up, and up. But now, in 2022, everybody seems to be panicking. It's a very turbulent year, and something else happened, something that had never happened in the last 14 years. Rising interest rates. Okay, I'm exaggerating a little bit. Interest rates actually went up during the Trump administration. But what is different in 2022 is that interest rates are rising very rapidly, as you can see there. But let's start from the beginning. Let's see first what are the factors that make the general prices of stocks go up and down, and also what is the relationship between interest rates and the price of stocks. I could blabber for hours and hours showing you very complex mathematical models, but let's forget about all of this for a second, because the reality is very simple. There are only two factors that determines the price of stocks. Yes, only two factors make the prices of stocks go up and down. The first factor that determines the price of stocks is earning expectations. In other words, the amount of money that the investors expect the companies to earn in the future. And listen well, I said earnings expectations. They're not necessarily the reality. Those are just, well, expectations about the future, and those expectations can be completely biased or unrealistic or overly optimistic or overly pessimistic. Investors are forward-looking. It means they're always looking into the future to determine what is the price they're ready to pay for stocks. In conclusion, the higher the earning expectations, the higher the price of stocks. The lower the earning expectations, the lower the price of stocks. And as I said, those expectations do not represent necessarily the current reality. For example, in March 2020, at the beginning of the COVID-19 pandemic, all the stock markets went down significantly because those investors expected all those companies to have less earnings because of the COVID-19 pandemics and all the lockdowns. And just because of those expectations went down, well, the prices of all stocks almost went down also. Or to take a more individual example, you probably noticed that the stock price of Netflix crashed. And again, that is only because of earnings expectations, because of some news, such as the decreasing number of subscribers and so on, reduced the earning expectations of Netflix. And as a result, the price of the stock went down significantly. Just because forward-looking investors adjusted the earnings expectations of Netflix. They expect now Netflix to earn much less money than previously, and the price of the stock went down accordingly. But don't get me wrong, those expectations can also be completely biased, irrational, overly optimistic, or overly pessimistic. You can imagine all those forward-looking investors as one single person, Mr. Market. And Mr. Market determines what is the earning expectations of stocks. And since Mr. Market determines the earning expectation of stocks, he also determines the price of stocks. But one thing that you have to know about Mr. Market is that he suffers from a very bad mental illness. He has bipolar disorder, which means that he has severe mood swings. He can go suddenly from being super happy, super exuberant, very optimistic about the future, and the next day, for no reason or for very little reason, he can swing to be completely depressed, panicked, and pessimistic. And the mood swings of Mr. Market explain why stock prices are so volatile, why they tend to boom and suddenly crash. And a perfect example of that is the year 2000s with the dot-com bubble. In the 90s, Mr. Market was completely euphoric. He was overly optimistic about the performances of stocks in the future. The earnings expectations were sky high. And then, in the year 2000, suddenly Mr. Market became overly pessimistic, very depressed. He expected the earnings suddenly to be much lower, which made all the prices of stocks to crash. So all of that being said, I think you got it. Earnings expectations are a key factor that determines the price of stocks. And there is a very good metric, a very good indicator to tell you how high the earnings expectations are. This metric is called the Shiller PE ratio. The way to calculate the Shiller PE ratio is elegantly simple. You make the sum of all the stock prices of a specific market, such as the New York Stock Exchange, for example, and then you divide it by the earnings of all the stocks of that specific exchange or market. So very simple, it is a division between the price and the earnings, hence the name PE ratio. And this indicator is very useful to tell you what is the mood of Mr. Market, whether Mr. Market is euphoric or depressed, or, in other words, to tell you what is the earnings expectations of investors as a whole. The higher the PE ratio, the higher the earnings expectations. The most Mr. Market is euphoric. The lower the PE ratio, the lower the earning expectations. The most Mr. Market is depressed. This chart here shows the history of the Shiller PE ratio. And as you can see, before the year 2000, the ratio was really high. It was even sky high, which means that also the earnings expectations were sky high. Mr. Market was very euphoric. And then suddenly in 2000, it fell drastically, which means also that the earnings expectations fell drastically. Mr. Market was depressed. And if you look at 2021, early 2022, you can see that the ratio was again sky high, almost as high as in 2000, which means that the earning expectations were again very high in 2021, early 2022. We're gonna talk more about it in a minute. So I think you got it. The factor number one that determines the price of stocks is the earning expectations. And the second factor and last factor that determines the price of stocks is called the discount factor. The discount factor is the opportunity cost of investing in stocks. And to make things simple, we can say that the discount factor is equal to the interest rate. Sounds confusing, right? Let me explain. Let's take an example. Imagine that the interest rate is high, let's say 7%. It means I can get a 7% return, which is an interesting return, just by letting my money at the bank and not doing anything, not taking any risk. In that case, I would never be interested to invest in stocks. Why would I invest in stocks that are much more riskier, much more volatile, much more unstable, when I can get the same return by just putting my money at the bank and taking no risk? And a lot of people will arrive to the same conclusion as me, and as a result, the demand for stocks goes down, and the price of stocks also goes down. And if the price goes down, the return goes up, because the dividend is the same, the cash flow is the same. And if the price is lower, well, the return, which is the profitability, is also higher. People will be interested to invest in stocks only if it gives, let's say, a 10% return per year. Only if it gives a higher return than the interest rate will people be interested to take the risk of investing in stocks. That difference between the return of stocks and the interest rate is called the premium. And remember that stocks always have a positive premium, which means that the return of stocks is always higher than the interest rate. So I think you understood where this is going. The higher the interest rate, the lower the price of stocks. And the reverse, the lower the interest rate, the higher the price of stocks. So now you know everything you need to know about the price of stocks. The price of stocks depends on two things: the earnings expectations and the interest rate. That's it. It's as simple as that. Well, all of that long explanation to come back to our original question. What will be the effect of rising interest rates on the stock market? To answer this question, we should look at the stock market as it is today. What is the current situation according to those two factors? As I said previously, when we look at the Shiller PE ratio, we see that in 2021 and early 2022, it was almost at an all-time high, almost as high as in 2000, which means that earning expectations were already sky high. And the only way for the stock market to keep progressing under those conditions is for earning expectations to keep going up, up, and up. Given that earning expectations are already very high, it doesn't seem very realistic that they're going to keep going up, especially with everything that is happening lately in 2022, with the war in Ukraine, the disruption of the supply chains, the high price of oil, the lockdowns in China that are again disrupting the supply chains, and so on. So now we know it's because of earning expectations that stocks were so high as they were in 2021 and early 2022. Now let's talk about the second factor, interest rates. And since 2008, since the great financial crisis, interest rates in the US and most Western countries was at almost zero. And in some places, like in Switzerland, it was even negative. Given that interest rates were so low for almost 14 years, created a very specific phenomenon. A phenomenon called in Wall Street TINA. There is no alternative. Tina or Tina? I don't know. Since interest rates were so low, depositing money at the bank or investing in government bonds was completely uninteresting. Nobody did that. And if you wanted to have some kind of return, so if you wanted to make your money work for you somehow, you had no other option than investing in stocks, which increased the demand for stocks so much. And it explains also why stocks have been so high all throughout the 2010 decade. But now, since interest rates are going up, suddenly depositing money at the bank became interesting again. Investing in government bonds became interesting again. So all those people who were forced to invest into stocks, who were invested into stocks but didn't really like it, suddenly they have alternatives. So they're going to divest from stocks and put it in certificate of deposits at the bank or in bonds. And this reduction of demand for stocks obviously is going to have a negative impact on the price of stocks. And also, as we saw previously, there is a negative relationship between stocks and interest rate. So the only fact of interest rates going up is going to have a negative impact on the price of stocks. And it's already happening now. Markets are going down because suddenly there is less demand for stocks and the interest rate is higher. And for those reasons, those markets are having a correction or a bear market if you prefer. And it's also interesting to see that the biggest winners in 2021 are also the ones who are hit the hardest in 2022. I'm thinking specifically about high-tech stocks such as Facebook, Netflix, Amazon, and so on. The only way to stop this decline is that the central banks in Western countries reduce the interest rate again. But that's very unlikely to happen since inflation is still going up. So they're not going to stop to increase the interest rate until inflation is under control. And that, unfortunately, seems not to be under control yet. Yeah, so the stock market seems to be headed in only one direction, down. And also, I found this interesting chart. It shows us that each time there was a big market correction, it happened when the interest rate was high and that the interest rate remained high for a prolonged period of time. And we're probably heading in the same direction with rising interest rates that are probably going to stay high for a while. So again, another negative impact for the stock market. But wait a second, who said it was necessarily a bad thing when stocks go down? I know, it sounds crazy what I'm saying, but what if I told you that actually stocks going down is a good news for everybody and good news for you? Stocks are getting cheaper, but for some reason everybody's getting sad about it. But look at it this way. If you went to a mall, for example, and you see that everything is 20, 30 or 40% cheaper, you would be very happy, right? So why would it be any different for stocks? Since the earning expectations are going down and the interest rate is going up, it means that stocks necessarily are going to give you a higher return. They're going to be more profitable if you buy them now than if you had bought them the year before in 2021. So if you're a new player and you're getting into the market, stocks going down are a very good news. And even if you're already invested, even if you're already into the market and you're losing money right now because you bought stocks very expensive in 2021, well, don't worry, don't sell, because sooner or later it's gonna catch up. The price is gonna go to 2021 levels again and beyond. It's always like that. So even if you were already into the market, it's good news. You should buy even more now and never sell. So, ladies and gentlemen, the sales period is open for stocks. And remember that Always make the best out of every situation. That's it for this video about the interest rates and stocks. As always, I hope you enjoyed this video and learned something from it. If there is a topic you want me to cover in a future video, please shoot me an email to the email address that is in the description below. And if you want to find out how Virgin Atlantic was created, check out this video. And if you want to find out how Nike could take over Adidas, check out this other video. And of course, don't forget to subscribe. And I will see you soon.